How much dividend income will $100,000 generate? $100,000 is a great start to a retirement portfolio if you're younger, but how much money can you expect to receive from this much capital? Would it be enough to fund your car payment, cover your mortgage payment, or maybe even enough to cover your income needed for retirement? Perhaps it would be enough to provide peace of mind to see that regular income hitting your account, regardless of whether or not you're working. Depending on your investing style, you might be surprised at how much you would receive from a $100,000 account. Take a look at how much dividend income that could generate and learn how you can maximize the profits to reach your goals quicker. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. It goes without saying that the amount of income you will receive depends on where your money is parked. You could invest in a general broad market index fund that will track the entire S&P 500. You could buy individual dividend stocks to maximize growth and income, or you could purchase a mixture of both. Dividend yields will vary based on the aggressiveness of your portfolio and should ultimately depend on how long until you retire. You don't want to be invested in solely income investments way before your projected retirement date simply because overall returns are lower with dividend-paying stocks. This is because they're not fast-growing companies, but rather older, blue-chip alternatives. High income is nice to have, but is ultimately irrelevant to younger investors. If you invest your entire $100,000 into a fund that tracks the S&P 500, you could expect an average amount of dividend income, meaning it won't be geared towards income or growth, but a combination. Since you're buying the market, your income and overall returns, including capital appreciation, will be average. Currently, the S&P 500 has a dividend yield of about 1.5%. That means that you would receive $1,500 per year, or an average of $125 per month in dividend income. Payments are typically made on a quarterly basis, which would equate to $375 each quarter or every 3 months. While the dividend yield isn't particularly high, the overall return has averaged about 10% annually. Receiving this type of dividend income is ideal for the average investor because it provides a near-perfect combination of income and growth. Even if someone were to spend the entirety of their dividend payments, they would still see considerable investment growth over time. To achieve a higher growth rate but lower dividend income, one might choose to invest in an S&P 500 growth fund. A fund such as this would hold the fastest growing companies that are held within the S&P 500. This is great for people who don't plan on retiring for quite some time and don't rely on their dividends. The yield will probably only be about 0.5% because many of the holdings are technology companies which pay little to no dividends. With a $100,000 investment, that's only $500 per year, $41 per month, or $125 per quarter in dividend income. Although that's quite insignificant, the capital appreciation will be higher than average since the companies are fast-growing businesses like Apple, Microsoft, Tesla, Nvidia, and Google. These companies have very small dividends, if any, because they prefer to grow the business instead of distributing income to shareholders. Since the dividend income is only 1/3 of the S&P 500, you'd need 3 times the capital invested to receive the same amount of income. But since the growth is high, you could reach that number much more quickly. If higher dividend income is something you'd like to achieve and don't mind a lower overall rate of return, you might consider buying a fund that's designed to specifically provide higher than average dividend income. A good example of this type of fund is SPDR's S&P 500 High Dividend ETF. It owns companies that have the highest dividend yields that are included in the S&P 500. These funds almost always experience slow capital appreciation because the companies held are focused on generating consistent profits and income for shareholders instead of trying to scale. Keep in mind that even when considering the dividend payments, returns will likely be lower than a higher growth alternative. That's why this type of investment is usually only recommended for those who need retirement income immediately and don't have time to watch investments grow over time before taking income. Some investors choose to purchase single dividend stocks that meet their criteria. Everyone has their own preferences in terms of characteristics of a stock, but dividend investors usually seek those with a history of dividend growth. They also want future dividend growth in addition to a company with growing earnings and profit to ensure their share price will rise as well. A dividend stock that yields 10% but loses 20% of its share price every year is a bad investment, but many novice investors are lured in by an extremely high yield. Individual stocks are the riskiest option, but they also allow for the most upside. Since share prices move independently, it's easy to spot a particular stock that's on sale for various reasons. On the other hand, some stocks are equally overpriced. It's hard to get a deal when purchasing funds because all the stocks are priced together. The ability to purchase an individual stock on sale is what's most attractive to investors. Think of it like buying a fixer-upper that's priced way below market value with massive upside. It's easy to grab that rundown home on sale while the immaculate property on the other side of town is priced at a premium. One example of a single dividend stock is Iron Mountain. Their business is storing, protecting, and managing information and assets. It's one of the highest yielding stocks in the S&P 500 due to the fact that it's a REIT, which is typically the type of stock with the highest yield. It pays a 7% dividend, which means you'd receive $7,000 per year or about $580 per month in dividend income. That's a pretty sizable amount, and hopefully the share price will continue to rise, earning its investors good capital appreciation as well. Its earnings don't grow that much compared to its peers, but the dividend income is why most would own it. While it's not recommended you pile all of your portfolio in one single holding, Iron Mountain is a good example of what you could potentially purchase and receive a nice amount of income for doing absolutely no work. In addition, if you have a portfolio consisting of maybe 10 quality stocks, the chances of one of them being on sale at any given time is high, so you can always get a great deal. The amount of dividend income generated from a portfolio this size isn't exactly a large amount of money. That's not to say that some people wouldn't be comfortable with this amount combined with another source of income, such as a part-time job or maybe Social Security income. Considering the average Social Security benefit is about $1,500 per month, another few $100s in spending money is attractive. Perhaps a couple with a paid-off home and low expenses could live happily on Social Security in addition to some dividend income. If a retiree is working a part-time job 20 hours per week at $13 per hour, that's about $1,000 per month, and dividend income would be nice to add to that. Otherwise, it could be enough to cover transportation expenses, a vacation fund, or even a small mortgage payment. Even though these income amounts aren't particularly high, the power of these dividends reinvested over time can be huge. Dividend investing has increased interest from younger investors, but they need to keep their goals in mind in order to determine the best strategy that will provide them with the most money when they decide to use it. Should you invest in income investments, something that will track the overall market, or growth investments that tend to outperform the market? A broad market fund like the S&P 500 might be the best of both worlds. Consider the amount of dividend income you might expect to receive from these different types of investments. Then, you'll have an idea of the investment strategy to implement and the amount of money needed to reach those income goals.